Hi, my name is Rajesh. I am a multifamily lender in Los Angeles, and today I will be explaining some of the tools that I use. So this is my cash flow calculator. This basically allows me to see the value of the property today versus in 30 years from now. And the reason it works is that I enter economic conditions such as, you can see down here, yearly inflation based on currency over the past 100 years, yearly appreciation of properties in a specific zip code or city or county based on the past 30 years, and rental inflation for that same area. I also look at vacancy rates because no property has 100% occupancy or is fully rented out 365 days of the year for the entire 30 years. You're going to have some days that are vacant. And based on that, applying, for example, yearly inflation to costs such as maintenance, gas, utilities, insurance, and legal fees and property management fees, you can come up with an estimate of what it costs today versus 30 years from now. Same thing with yearly appreciation. We look at, or rather this tool looks at the property value paid, what that property value will be in 30 years, assuming that same average out in appreciation over the next 30 years. Property taxes are actually based on that yearly appreciation because I look at property taxes as a percentage of the property value starting at the purchase price. Rental inflation looks at rents over the next 30 years, and vacancy is deducted from all of that. And the basic idea is this. We look at all of our upfront costs and all of our upfront income, and based on the difference of that, given these economic conditions, what does it look like today and what does it look like 30 years from now? So you basically take all your income, you deduct all your expenses, and then that's what you have for this year. Then the next year you apply these economic conditions and you look at your income again, you look at your expenses again, you deduct the two, and that's what you end up with. And you do the same thing for the next 30 years. And that's how I use this tool to sort of guesstimate what this property or a property is going to be worth 30 years from now when you decide to sell it, how much you're going to end up with when you sell it. That's the cash flow calculator. I'm still working on a web-based version of this, but if you would like this calculator, just leave me a message, leave a comment in the video, or email me through my website. I'll be happy to send this to you. And this is a DSCR calculator. You can actually get this just by going to lamortgagedude.com/DSCR-calculator. You can see the URL right there. And it's also in the comments. In the description. The way this one works is a little bit different. This is an underwriting calculator. When we underwrite, we have to look at the gross DSCR ratio as a DSCR lender. And for agency loans, we look at the net DSCR ratio. The gross DSCR ratio is basically all the gross rents, the qualified gross rents, minus principal, or rather divided by principal, interest, taxes, and insurance. So here you've got property taxes and insurance. Those are considered operating expenses. And we look at it on a monthly basis, or rather yearly over yearly, or monthly over monthly. It's got to be the same thing. So gross DSCR ratio on DSCR loans has to be the gross rents over the PITI, principal, interest, taxes, and insurance. And on a bank loan, it's a little bit different. The way that works is that they deduct all these operating expenses here from the qualified gross rents, and that leaves you with something called net operating income. From there, that's where the mortgage payments are paid from, not from the gross rents, but from the net operating income. And the way that DSCR ratio is calculated is by looking at the net operating income divided by just the P&I payments, just the monthly mortgage payments right here. And that has to equal at least 1.2 or higher. Whereas on a DSCR loan, it has to equal 1.0 or higher when we go the non-QM route and get the lower interest rates. And the other thing this calculator does is show you cash flow at the bottom. So just because you can get this at a lower down payment in this example, with this DSCR loan, you can get it for $1.5 million down versus $1.9 million down, because DSCR ratios are calculated differently. What you're going to see is that the monthly payments will be higher because the loan amount is bigger versus lower monthly payments here where the loan amount is lower. And as a result of that, because your monthly payments are higher, you're actually losing money every single month in terms of cash flow after you account for the operating expenses. Whereas on a bank loan, they've already accounted for the operating expenses before they start deducting the mortgage payments. This ensures that you cash flow. Now, you can still cash flow with the DSCR loan. You just have to put a bigger down payment. So let's see, you want to cash flow 1098, right? Or $1,100 a month. You're actually going to have to put down $200,000 more, but that's only because of this interest rate right here. With the bank loan, you're going to get much lower interest rates right out the gate because they know the risk is low because you're already cash flowing when they approve you for the loan based on their formulas that they use. Whereas with us, because of the inherent risk, our interest rates are a little bit higher. But that doesn't mean you cannot buy down the interest rate. You can still buy down the interest rate or prepay that interest payment and finance that into the loan amount so that the seller is, in fact, in a way, sort of paying for it. The seller, let's say a house costs $1 million. You want to prepay $100,000 in interest, and you say, hey, this property isn't worth $1 million to me. It's worth $900,000. You negotiate that price with the seller, and you say, but instead of just knocking the price down by $100,000, I'll still keep it. We'll still keep the sales price at $1 million. Just give me $100,000 towards closing as seller credits, and now you take that $100,000 and you buy yourself a lower interest rate by prepaying that interest up front. And you can do that pretty simply by just buying down the interest rate. And as a result, you get a lower interest rate, and over here, as a result, you get the same cash flow. So same interest rate, different DSCR ratios, but your down payment is the same, your monthly payment is the same, and your net cash flow is the same. So that's why there's a difference between gross DSCR ratio and net DSCR ratio, because it calculates it looking at qualified rents divided by PITI payments versus net operating income divided by just monthly P&I payments, more principal and interest payments. So given the same interest rates, same terms, same down payments, your cash flow is going to be the same, even if the DSCR ratio comes out differently. And from an underwriting perspective, this actually helps me when I'm popping these numbers into a pricing engine, rather than having to sit there and manually calculating the minimum down payment I have to do to get a certain cash flow for my client or get a certain interest rate threshold for my client based on DSCR ratios. So let me actually expand on that. So depending on your DSCR ratio, you can unlock different interest rates. So let's say you have a 1.0 gross DSCR ratio. Well, that is obviously not good because you're not cash flowing, and that implies there's higher risk. But because of that higher risk, you are trapped with a higher interest rate because interest rate is based on perceived risk. And as a result of that, in order to hit that same DSCR ratio, now you have to put down a bigger down payment because we have to look at the monthly payments plus property taxes and insurance when dividing it by gross rents. So we have gross rents right here, which is $13,000, divided by monthly payment plus, which is $97.60, plus $3,000 plus $550. So $35.60 right there. $35.60 plus $97.60. That's approximately equal to the $13,320 over there. So 13,000 divided by 13,000 is equal to 1. And that's how you get this gross DSCR ratio. But in order to get approved for that loan, or rather, in order to get approved for that loan, if your total monthly payments were, let's say, $14,000, you have to increase the down payment until the loan amount was small enough so that the total mortgage payments were equal to $13,000 or less. And when it equals to 1, when it's 1 to 1, when gross rents are equal to the mortgage payments, there's a higher interest rate. Now, however, when you get, let's say, a lower interest rate, let's say you get a higher DSCR ratio. Let's imagine, for example, that this was not $13,000. Let's say the gross rents were $18,000 a month, right? Okay, so let's say gross rents were $18,000 and $19,000 a month. Yeah, let's say $18,000 a month. And now, to get that same 1.0 DSCR ratio, you only need to put down $1 million instead of $1.5 million. Your interest rate stays the same because the interest rate is based on the DSCR ratio. But let's say you put a bigger down payment. Let's say you put the same $1.5 million down, right? 598. Or 55% down because the purchase price has not changed. Now your DSCR ratio is at a 1.357. That means you just unlocked a different interest rate. And normally what that interest rate is at anything 1.2 or higher, you can get as a par rate. Means you do not have to buy the interest rate down to get this interest rate. It's a 6.999 as of right now. And today is November 17th, 2025. So if you were to get a property with a 1.2 DSCR ratio, and you got that with a 6.99% interest rate, you'd only have to put down $1.17 million. So you can see how this calculator does the math for me. And that way, when I punch it into my pricing engine, I don't really have to think too hard in order to price out different scenarios. Because the end goal of every investor is to stay as liquid as possible, which means putting as little a down payment as necessary and get as much cash flow as possible. And the way to get as much cash flow as possible is, of course, lower the interest rate. So you want to figure out, I want to figure out what that combination of numbers is. And because it's all sort of tied into each other, if I adjust one number, all these other numbers adjust. And rather than doing it by hand or sitting there with a calculator punching in numbers manually, this calculator automatically adjusts all those numbers and comes up with the answer for me. So let's say I want, 1739, right? Which is the same as the net cash flow here. I can actually go interest only and now I'm putting in about $40,000 less. But I can also buy down that interest rate to the same 5.875, and now 746. 746. So now I only have to put in $1.1 million versus $1.4 million. So normally a client will come to me and say, what's the lowest down payment I have to put on this building, and what's the lowest interest rate you can get me? And given those two factors, I can use this calculator to sort of come up with it. And I'll also be straight up with them and say, hey, you're not going to cash flow on this building unless you do this. And with 1 to 4 unit buildings, and I say 1 because it's a single family home, these are usually paid by the tenants. So we're talking water, gas, electric, trash, maintenance, pest control, legal, advertising, and property management. Unless you're like a Blackstone or somebody, you're usually self-managing these properties unless you've got like 100 doors or something, because that's when it sort of makes sense to have a property manager, or you've got a full-time job as a software engineer or a doctor or a lawyer, and you're just using this to sort of write off from your income. And so then you definitely have a property manager, because your full-time job takes up all your attention and you don't want to be bothered with it. So, and property management fees generally range from 5% to 10% of gross rents. And the fewer doors you have, the higher, on the higher end of that spectrum it ends up being. The more doors you have, the lower end of that spectrum it ends up being. With 1 to 4 units, you're generally looking at property taxes, insurance, and maybe some legal fees as your general operating expenses. When you're working with 5+ units, water, gas, electric, trash, they end up being expenses in the common areas because it is a commercial building. So like trash, you probably have one of those big waste management bins that need to be picked up by a specialty company rather than just by the city. Maintenance, I always like to calculate maintenance at about 10% of gross rents, because even if it doesn't cost me that in a month, in a year, when you multiply 1,800 in this example out over 12 months times 12, 21,000 in a year on maintenance. Roof issues, water heater, gas boiler. There are issues that can probably expensive move outs where the tenant wrecks the place. All of these things can go under the maintenance banner. Also lawn care. Lawn care, you're probably looking at anywhere from $100 to $150 a month if you have lawn in a bigger property. So these are things that do add up and take away from your cash flow, so it only makes sense to account from it. So when doing these things, I like to look at, again, all my income, all my expenses, I subtract the two, and that gives me my cash flow. The better you know the business, the better you know what expenses you're going to be taking on. Most people, when they do this, they only look at gross rents and they subtract the mortgage payments and they think, that's it, that's my cash flow. And that's not exactly true. You have a lot of other maintenance costs, operating costs that go along with running a business, just as you would with any other business. If you're running a restaurant, you have employees to pay, you've got inventory, you've got raw food, you've got supplies, like let's say the chef breaks their knives, you need new knives, you need to take care of the tables, you need to take care of the seating, you gotta fumigate for rats if you're not keeping the place clean. There's a lot of you need napkins. You got to buy paper napkins, or you got to buy the proper cloth napkins. Either way, depending on regardless of what type of restaurant you're running, whether it's fast food or fine dining, you're going to have a certain number of fixed costs every month. And even if they're one-time costs, they're recurring costs every year, and you can defer those over the 12 months and figure that out, what it's costing you on average every month and every year, once you've been in the business long enough. So yeah, that's the point of these calculators. That's how they help me figure out things. And if you're an investor and you'd like access to these tools, well, now you have them.